Hello traders, Gary Wagner here, just about 10:15 in Honolulu, 4:15 in New York. It is Thursday, September 15th, 2016, and this is the Daily Report for Gold and Silver. We do have some moderate to strong downside pressure in the market as we witness an extremely powerful risk on day with equities really getting flooded with liquidity and equity moving to the upside. Dollar actually weaker on the day, so we can't even pin this on the dollar. We have to pin this on solid selling in the market. Now, when we look at spot gold, 13.56, 13.60 with a low of 13.09 and a high of 13.28 on the day. When we look at COMEX of course does have a premium, 13.17 currently, off $9 on the day, the low 13.12 and the high 13.32. Silver, interesting action in silver because it had been trading higher for the better part of the trading session, but then as we got closer to the close of the markets, we did see it come off, closing off almost a cent and a half, not that much, at 19.50. That's of course when we look at COMEX, which is closed. We do have Forex or spot still trading. That is still showing a net gain, a gain of about 4 cents at $18 and call it 99 cents. So traders, as we look at this close today, gold trading off roughly $10 on the day, 13.1640. That is current print and close of COMEX gold. As I said in our opening statement, you cannot really account the U.S. dollar for anything in this particular sell-off. Looking at the Kitco Gold Index, I've got it in the upper left-hand corner. And as you can see, we did have a nominally, or fractionally, I should say, weaker U.S. dollar. That actually giving some strength to gold, giving it about 40 cents. But of course, once you account for selling in the market, which was about $10.80, you really see that this net change of 1040 is directly due to selling in gold. Now, let's take a look at the technicals. And to do that, I absolutely want to get rid of this one chart. And what we have is a simple bar chart. And I'm using a bar chart rather than a standard candlestick chart, which is typically what I will use. And the rationale behind using that is I really want to focus on these highs and lows for this particular study. And the study that I'm referring to is just a basic fib retracement. This starting at this bottom at 1305, taking us up to the top at about 1357. We have our various hash marks, 23, 38, 50, and 61. Those are expected areas of any kind of correction. In other words, as a market moves up, we'll typically retrace. That would be a impulse wave moving up, a corrective wave moving down. Now it's the amount given back on this corrective wave that we're talking about. Did it give back 23%, 38%? Did it give back half or 50% and so forth? And then typically on a market that is in rally mode, it will then return to a impulse pattern, so to speak, where we have an impulse wave, corrective wave, and then another impulse wave, this being 1, 2, and 3. Now, as the market begins to dip, the deepest we typically will expect is a 61% retracement, and we actually call that a deep retracement. Now, it can go as low as 78. That is a rare and unusual occurrence. It's not something that I like to see on any kind of a bullish mode, but here we are. You can see this little hash mark right here. That hash mark, of course, is letting us know where the market closed at, and it 13.1770. It is now active again, 13.7080. So it is trading right on this line of a 78, or excuse me, yes, a 78% retracement. It really needs to hold this particular area. I'm not so concerned about the low in this particular instance as I am about settlement. So that if it settles above this particular hash mark, meaning around 13.17, and it's currently trading 13.18, there is still a ray of hope, so to speak, that we will see this market recover. And so what we will be looking at is a rally, a really deep retracement, 78%, and then a return to the rally. If we break far below that, the next real level of support is 1300 to 1305. For right now, we absolutely want to remain sidelined with no active trades. I want to see what happens when the dust settles, and most importantly, whether or not this particular critical area in gold will hold. Now, as far as silver goes, we're looking at COMEX futures on $19.04, down about 3 cents on the day. It is absolutely a doji candle, meaning the open and close are pretty much identical. A 3-cent move is absolutely a doji. You can see that right here. Now, in terms of a technical basis and the longer-term fib retracement, our next or our real major support level comes in between 1825 and 1850. Of course, 1825 matches up with a fib number. This 1850 with these bottoms right in here. Now, of course, $19 per ounce is going to be a highly psychological level, and we do want to add one more fib retracement. Let me go ahead and put that in. So traders, I've just gone ahead and added that fib retracement. You can see that here with our hash marks right in here. In essence, a much more short term, so we can attempt to see where this number kind of falls in the closer picture. And doing that, we have 1583 as our low. We have pegged our high as this particular high here. This to me is almost an aberration in terms of an extreme move in the market, so I'm more comfortable adding it at these highs that come in at about 2085. So 1880 to 2080, rounding it off. And when we do that, we do get a couple of areas, and of key importance right now is 1393, of course, close to 1900. And so that's the fib retracement that really, on a technical basis, is providing some support for the market. Of course, below that particular price point is going to be a 61% retracement and a 50% retracement. In fact, let me make sure that gets drawn in. And so you can see that I've just added the 50% comes in at 1832, and it does match up with this 1832 to about 1850. That is the major level of support. Behind that is 1875 and of course 1900, which is where silver is currently at. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow on Friday for the weekly wrap-up and review. Bye-bye.